So here we have a combo problem. We're going to be allocating income to the Page and Childers partnership, and then they're going to admit Smith into the partnership. So we'll see how to do that. We're also going to do some journal entries, and so that you can see not just the schedule of calculating the amounts, but also the journal entries that the partnership would make. All right, so we have a new partnership, so their initial contributions we can put in here. So Page and Childers, we got $80,000 cash from Page and $30,000 cash from Childers. So that's sort of your beginning partnership capital, if you will. All right. Then it tells you that each partner gets 10% on beginning capital. So let's do that. The initial contribution would be the beginning capital. Okay, and then they say compensation allowance, $5,000 goes to Page and $20,000 to Childers. Okay. And now they tell you that the remaining income splits 40-60 to Page and Childers. And so we've already allocated $36,000 of income here based on the partnership agreement. If income is less than $36,000, we'll be allocating a negative amount because you can only allocate total income among these three possible directions. If income is above $36,000, then this remainder would be a positive number that's going to be split 40-60. All right, during the year, profits were $26,000. So that means we've over allocated here, and we need an amount where what's in this box is $26,000. So what would that be? That would be $26,000 minus what's already been allocated. We have some withdrawals. That is not part of the income allocation, but we can put that in here. All right, they also tell us that in addition to this activity of withdrawal and profits, that the business paid $5,000 to repair Page's house and charged it to the repair expense of the partnership. So that should have been counted as an additional withdrawal for Page, personal expenses, and it should not have hit the profits of the partnership. So this 26 really should be 31, and there should be 5,000 more taken out of Page's account. So we're going to go back now and adjust this to be 31,000. So we are actually making a correcting error to the partnership for that $5,000. We're charging it against Page. We're going to be crediting repair expense, which will be making income $5,000 higher. So now we can allocate this $5,000 based on the 40% and the 60%. All right, so that's the end of the first year. On January 1st of the second year, the partnership admitted Smith and gave 20% of the partnership capital to Smith for $43,000. We know a couple of things. One is we know that the partnership capital is going to go up by the cash that's contributed. Right, so assets are going up, and so the net assets, which is the capital, will be going up. But Smith isn't going to get credited for the cash that's contributed. Smith is going to get credited for 20% of partnership capital. And so 20% of partnership capital would be 20% of the capital before the contribution plus the contribution. So that's the capital prior to admitting in plus the capital that's being contributed in times 20%, the share of partnership capital. And so the difference is a bonus because what Smith is credited is smaller than the cash that was brought in. That difference gets spread is a bonus to existing partners in their income percents. So the difference between these two times the income percent. Have to put your parentheses to override the order of operations there. Okay, and so the capital balances after Smith has been admitted. And of course you can check to be sure this is correct. If it is correct, the $32,000 better be 20% of the 160. So you can always check that, make sure you did it correctly, and so that's correct. So what are the journal entries here that need to be made? The first thing we're going to do is correct that expense that was charged to the partnership that should have been counted as an additional withdrawal. Let's do that. So we're going to add $5,000 to the withdrawal account for Paige, and we're going to credit the repair expense. Okay, so now we're going to allocate that summary. Let's change the my note, since we adjusted profits to the new amount here. So these three had to equal net income for the year, which was originally 26 till we made this journal entry just now, and now that profit is 31. So we need to do the journal entry to spread that 31. So let's do that. So we would be debiting income summary. So income summary would be where all the revenues and expenses would have been closed out to. And so then we're debiting income summary, and we are spreading the profits for the period to Paige and Childers. So where did $11,000 come from? So for Paige, that was these three accounts netted together. 8,000, 5,000 minus 2. And for Childers, it was the 3,000 plus the 20 minus the 3. And now we have to do the journal entry to admit the new partner. So let's do that now. So we're going to record the cash that Smith is bringing in, and we're going to give Smith the $32,000 that we calculated, and then the bonus to the existing partners based on their 40-60 split of the difference between the cash and what Smith is entitled to as his percent of the equity of the partnership, or the capital of the partnership. So there you go. Move on to the next one.